Hi there. In this video, we explain how marriage allowance works for retirees and how couples can legally reduce their UK tax bill.
Hello and welcome. Today, with a little help from our friends at My Tax Accountant, we're diving into a huge UK tax-saving opportunity that honestly thousands of retired couples are completely missing out on. So if you're retired and married, you're gonna want to stick around. This could genuinely put a good chunk of money right back in your pocket. Let's get into it. So what's with this number? £1,260? Well, that's the total tax rebate that thousands of eligible retired couples could claim from HMRC right now. And look, this isn't some lottery win or competition prize, it's actual tax relief you might be owed. What's really surprising is that HMRC itself thinks over 1 million couples aren't claiming it. So the big question is, are you one of them?
You know, to see how this works in the real world, let's meet Marjorie and Carl. They're a perfect example of what happens to a lot of retirees. They were getting caught by something called fiscal drag. It sounds complicated, but it's not. It's just when the tax-free allowances stay frozen, but your pension income creeps up with inflation. It meant that their pretty modest pensions were slowly but surely pushing them into paying more tax than they needed to. They just figured, well, that's the way it is, but it wasn't.
So how did they stumble upon this £1,260 tax surprise? Well, the solution is in a really simple but often completely overlooked tax break that's designed specifically for couples. It's called the marriage allowance, and that's exactly what we're going to break down for you. The idea behind it is actually brilliantly simple. The marriage allowance is basically a tax perk that lets one partner, the one who isn't earning much or at all, transfer a slice of their unused tax-free allowance over to their spouse. It's just a way for the two of you as a couple to be a lot more tax efficient.
Okay, so let's get right down to the most important part, figuring out if you actually qualify. For a lot of retirees, the criteria fits like a glove.
So just take a second and think about your own situation. Does this sound like you and your partner? Thinking about your total income from pensions, maybe some savings, or any little part-time jobs. That's the very first step.
It really all boils down to these 3 simple checks. First, you have to be married or in a civil partnership. That one's easy. Second, one of you, the lower earner, needs to have an income below the personal allowance, which is £12,570. This happens all the time when one partner has a very small pension or maybe none at all. And third, the other partner needs to be a basic rate taxpayer.
Now, what does basic rate taxpayer actually mean? This is a really crucial detail because it changes depending on where you live. For most of the UK, so England, Wales, and Northern Ireland, it means your income is somewhere between about £12,500 and £50,000. But, and this is important, if you're in Scotland, that upper limit is actually lower. It's just over £43,500. That's a little detail that can definitely catch people out.
Okay, so you think you're eligible. That is fantastic. Now, for the really exciting part, let's look at what this actually means for your bank account.
To make this all crystal clear, let's bring Marjorie and Carl back into the picture. Using their story really helps us see how these numbers play out in a real-life retirement.
Right, so here's their setup. Marjorie's total pension comes to just £9,000 a year. That leaves a pretty big chunk of her tax-free allowance totally unused. Carl's pension, on the other hand, is £21,500, which puts him right in the middle of that basic rate tax band. So you can see, they tick all 3 of those boxes we just talked about.
So because they qualify, Marjorie can transfer a fixed chunk of her allowance over to Carl, and that amount is always exactly 10% of the full personal allowance, which works out to £1,260. So Marjorie's tax-free allowance gets a bit smaller, and Carl's gets bigger. Simple as that.
And what does that actually do for their tax bill? Well, Carl gets a tax credit that's worth 20% of the amount that was transferred. So 20% of that £1,260 is £252. And that's not a complicated rebate, it's a direct reduction in the tax he has to pay for the year. That's a straight saving of £252 just for filling out a quick form.
So you're probably thinking, okay, great, how do I actually get my hands on this money? Let's walk through the claims process and, crucially, how you can claim for all those years you might have already missed. Now, this is where it gets really powerful. It's called backdating. You can actually claim for the last 4 tax years. That's right, 4 years of savings plus the current year. And now you can see how this all adds up to that big £1,260 figure we started with. It's a massive potential rebate just sitting there. Applying is actually really straightforward. For this tax year, the quickest way is to just hop online at the gov.uk website.
If you want to backdate your claim, you'll probably need to use a specific form or just give HMRC a call. The best bit? Once you've set it up, it's all automatic for future years. And all that backdated money, that shows up as a very welcome lump sum.
All right, now for a few expert insights, because, like any part of the tax system, there are a couple of little pitfalls you need to be aware of.
Okay, pay close attention here, because this is probably the #1 cause of confusion. The marriage allowance is not the same thing as the old married couples allowance. The key difference is your age. If at least one of you was born before April 6, 1935, you claim the older, much more generous allowance. For pretty much everyone else, it's the modern marriage allowance that we're talking about today.
And here's a brilliant pro tip from my tax accountant. It's not always a guaranteed win. If the lower earner's income is right up near the top of their personal allowance, transferring a bit of it away could actually push their own income into the taxable zone. Now, the couple as a whole might still be better off, but you absolutely have to do the maths just to be sure.
If you've got a pension that's paid through PAE, you'll see this change reflected in your tax code. The partner who receives the extra allowance usually gets a tax code ending in M, and the partner who transferred it gets one ending in N. It's just how HMRC makes the change happen automatically. And remember, if your situation changes, like say one of you gets a pay rise that pushes you out of the eligibility band, you have to tell HMRC so they can cancel it.
So, what's the big takeaway from all this? It's really simple. Don't just assume this doesn't apply to you. Taking a few minutes to check your eligibility could genuinely lead to you claiming back over £1,000. At the end of the day, it's your money, and it is definitely worth checking. And of course, just a quick disclaimer. Everything we've talked about is for general guidance, and it's based on the tax rules as they are right now. And as we know, those rules can and do change. For advice that's really tailored to your specific financial situation, it's always best to speak to a qualified professional.
And if you want that professional help, well, the team, My Tax Accountant, are ready to step in. They can confirm if you're eligible, help you through the whole claims process for this year and for backdated years, and just generally make sure your finances are as tidy and efficient as possible for your retirement. All their contact details are right there for you.
So, we'll leave you with this final thought. Could a simple check today put over £1,200 back into your budget? It's definitely worth finding out, isn't it? For more expert tips on how to manage your tax, make sure you subscribe to the My Tax Accountant channel. Thanks so much for watching, and we'll see you in the next explainer.